You've always heard that you need to invest, but you don't know where to begin.
Don't worry, leave that to us. We've been teaching people how to invest for the last 8 years and have helped over 45,000 people get started with investing in a simple way. And now we've made the process even easier by creating a course that teaches you how to get started investing in 5 simple steps. And it's called our L.E.A.R.N method.
Before you invest, you need to 1. Look at your financial position. 2. Establish your personal goals. 3. Assess your investment options. 4. Research the best options for you. And 5. Normalize investing regularly.
With these 5 easy steps, you can start your investment journey with confidence and clarity. But wait, there's more. We've created templates and resources to help you take action right away. After this course, you will know how much you have to invest, your investment targets and timelines, and how to invest to achieve your goals. Register now at learngrowinvestclub.com.
Hi everyone, so welcome to another video. Today we're going to be breaking down the balance sheet specifically for beginners. I'm going to introduce the balance sheet, how to use it. It's one of the 3 financial statements that we recommend that you understand as a beginner before you invest. So I'm going to continue on from the previous video where we went through the profit and loss statement. I'm going to use the same company so that, of course, you could put all the videos together and it will make sense to do a complete analysis of a company. All right, so the company that we used last time was Atlantic Hardware. So I'm going to use Atlantic Hardware in this example again to go through the balance sheet. Of course, this video will take maybe about 20 minutes, 30 minutes max, and then we'll take any questions that you have. Read the balance sheet for Atlantic or any other company. You know, either way, we'll keep it within an hour as we normally do. So let me just jump right in and get started here. So first, to locate the balance sheet for any company, we want to use what's called the instrument summary page, right? So this is a page that you want to go to first when you want to understand some details about a company, right? You start here, the instrument summary, to get a quick overview of the company, right? So price and some other information, we have that. And so, you know, this is where we go to get easy access to the balance sheet, all right? So if you look to the right of the instrument summary page, you see some sections here: latest news, quarterly financials, annual reports, audited financials. Now I'll do a video to maybe explain the differences between this here, but each company is expected to release their quarterly financials. Some of them may not release a Q4, instead they may release their audited financials, which will include their Q4. So you will see at least quarters 1, 2, 3, and then the 4th one may be included in the audited, and then the annual report is typically due, I believe, 90 to 120 days after the end of their financial year, right? So either way, you can use one of these links to get access to the balance sheet for the company. So I'll start with the quarterly financials. So I'll click on that here. Let me open it in a new tab. So here we have the quarterly financial statements, and we see here a few of them. The company has been listed a little bit over a year or close to a year now, so you'll only see 3 here. So I have the 2nd quarter, 3rd quarter, and 4th quarter. So in Atlantic's case, they did release for their Q4. So let's open this up in a new tab again so you see what that looks like. And so this is their unaudited 4th quarter financials for the period ending December 31st, 2025, right? So that's how you understand the information that you're seeing here. Unaudited just means that the numbers are prepared in-house. They haven't gone through the auditing process. And so these numbers may change depending on what the auditing process reveals, but in most cases, you can trust these numbers, right? Sometimes companies make revisions, so it's good to look at both, but you know, it's a good place to start. 4th quarter means that it's the quarter in question, and it's just saying that the 4th quarter ended December 31st, 2025. And note, this was released on February 16th. So the financials for the quarter are due 6 weeks after the end of the quarter, right? So 6 weeks after December 31st would have been about this point here, right? Around the 4 to 6 weeks is when we usually see the reports coming out. So that's why you have that here. So let's open up the report, right? So went through an overview of the report last time. We have 3 main statements that we want to look at. We have the profit and loss, which is where I start, then the balance sheet, then the cash flow statement. So of course, the next video in this series is going to be the cash flow statement to introduce that to you. And then of course, I'm going to go through the different sections. All right. So again, let me know if you have any questions here, and we can take them as they come. So before I go through the balance sheet, I just want to break down how the balance sheet works. All right. So the balance sheet, the equation is as follows. We have assets equal to liabilities plus equity, right? So you notice here that we have liabilities over one, we have assets over one side, and assets are broken down into 2 categories. We have non-current assets, which are your fixed assets. These are things that are like buildings, things that the company will use past a year. Then you have current assets, which are things like cash or inventory, things like that, right? So two categories of assets, which we'll get through shortly. And all of this, so let's say the assets are totaling $1,000, then everything on the other side, which is the liabilities and equity, will also total $1,000, right? And that's why it's shown in this way. So the liabilities now, these are the things that the companies owe, right? So it's owed to a supplier, it could be a loan to a bank, it could be payables in terms of vendors, etc. So it's either owed or borrowed in terms of liabilities. And then equity, now those go to the owners of the company. So shareholders, things like that, your retained earnings are stored there, things of that nature. All right. So both, when you add up the liabilities and the shareholders' equity, it will give you the same value as the assets. All right. So hopefully that makes some sense. Let's look at it in real terms. All right. So just to show you that the numbers balance, right? So here we have the assets for Atlantic Hardware. We have non-current assets, and then we have current. And of course, those 2 sections give you 1.4 billion. And we know it's billion because remember we said last time, we look to the top and we see these numbers are in thousands. So you add these 3 zeros to all the figures that you see here. So this is really 1.4 billion. So this is their total assets for their entire year 2025. And then when we look down to the total equity and liabilities, we see it's 1.4 billion. So again, the 2 sides will always balance out. That's why it's called a balance sheet, because both sides need to balance. And if you did accounting, whether in high school or university, you'll understand this quite well. All right. So since this is meant for beginners, I'm not going to go through every single line item. I'm going to try and keep it simple. Just some things that you need to be made aware of. Usually these terms are self-explanatory. So what you want to do is, if there's anything that you see that you don't understand, you just do a Google search, look at that particular, description, and then you can understand what's happening there. In some cases, companies are usually very consistent with how they list their, not everybody names things the exact same way, right? It may fall under the same category, meaning current or non-current, but I may call it something else, right? And I'll try to think of an example there, but that's sometimes how it might work, all right? So in this case, we start with our non-current assets. So we have property, plant, and equipment. Remember, we said non-current is anything that the company is really using on an ongoing basis, right? So look at it as their property, plant, and equipment. In this case, would be their location, the equipment that they may use to maybe make make the different tools. Let's say they have some sort of equipment or like anything major that would be there that is not going to be sold unless, of course, maybe they want to move on from that particular asset, but it's a part of what they use on an ongoing basis. And we also have here investments. So since it's on the non-current, I'm going to assume that this is just investments that they're holding for a long term. And then right of use assets, of course, again, I'm going to try and keep it simple here, but it's listed as a non-current asset. I'm going to define some of these terms that may be, needing a little bit more definition, but for now, just understand that it's listed on a non-current asset and it's valued at 165 million. All right. So then we have the current assets. Now, these are things that you're expected to be converted to cash within the first year or within the next 12 months. Let me say it that way. So we have cash and cash equivalents. Now, sometimes when persons see this, they're like, well, what is a cash equivalent? It just means that it's something that can be converted to cash very quickly. So sometimes it could again appear in different ways. It's not only cash in the bank, it may be other things, right? But either way, it is expected that the company is using it in terms of their day-to-day, the things that they would need cash for, all right? Accounts receivable and prepayments. So the accounts receivable is when customers owe them money. So in the regular doing business, they'll have, customers who take things on credit, but then you also have customers who may prepay for something that comes in as monies that they have to be able to work with. So it's considered a current asset. Of course, if a customer prepaid, then of course you're obligated to deliver that. So that's also a current a liability in the sense that when a customer prepays for something, you owe them whatever they would have prepaid for. All right. And then we have inventory here, which is the equipment in this case that Atlantic Hardware has to sell, right? So there are tools, their saw, hammers, etc. They have as their inventory, and they have 664 million of those items. All right. So we see the non-current assets here, 307 million, and then the current assets is 1.1 billion. Right, so we add those two together, we get 1.4 billion, and that's all of their assets, right? So pretty easy to understand here. The only thing that we didn't really define here is the right of use asset, and I'm specifically not getting into that right now, just to really keep it simple. Again, this video is for beginners, all right? So before I move forward, I wanted to show you that what they're doing here is comparing or showing you 2025 compared to 2024, right? So usually there are some things that you want to look at. So for example, is there any major change between the values from one year to the next? So, in this case, they had 290 million in terms of property, plant, and equipment in 2024, and now they have only 22 million in 2025. So it's safe to assume that they would have liquidated some assets, some property or something like that, for that significant drop, right? That's not necessarily a bad thing. If it's sold, that means it's likely converted to cash, and then now they might have it in some other form to be able to leverage, right? So it could be cash, it could be something else. We'll get to that when we kind of dig deeper as to what would have happened, but for now, we see that is a noticeable difference. We see where they have investments here of 118 million that they didn't have a year before. So investments would typically, sometimes companies would actually have investments as well, so that they can make use of the capital that they have. Could be short-term stuff, it could be long-term. It really depends on the company's strategy to manage maybe their extra cash. Maybe they want to invest to get their own income in terms of dividend. For each company, it would vary in that regard. The right to use asset actually decreased from 208 million to 165. And then we have the current assets now. So their cash would have grown from 31 million to 68 million. So the cash pretty much more than doubled. We have accounts receivable and prepayments increased by about 23 million. Now, this is a number that you typically want to watch for companies, especially I use smaller relative here because they are a junior market company. But receivables, usually if those receivables stay longer than 90 days, for example, they may have to do an impairment on those receivables, which means they may need to write off a portion because they may not be able to collect all of it, or for accounting purposes, they're required to do some sort of impairment. So I typically just watch to see how the receivables are managed. Now, I'm not necessarily always worried about a high number. It really could depend on the business model. In this case, they supply other hardwares, so they have to sell on credit, and the companies may take some time to repay. That's normal, right? So we just want to check the notes to see how these things are trending. Do they have to do any major write-offs at any point? I just understand that it's going to impact their cash, because when they sell on credit, they need cash to take care of their bills, pay their overheads, pay their staff, etc. And so receivables management is very important for any business. Next, we have inventory. So inventory, you really want to just see this number being managed. So they had 742 million of inventory. Now it's down to 664. It just means that that's either was converted to cash or was converted to accounts receivable, right? That's what that means. So we see their overall assets decreased from 1.6 billion to 1.4 billion. All right. So I'm going to pause there. Any questions on what I've covered so far? Is this making sense? Let me know in the comments, and I'll just address them when I'm done. So I'm going to go to the other side now of the balance sheet, which is the equity and liabilities. So I'm going to go through that, take any questions that you have, and then we take it from there. All right. So we have now equity, and again, for this side of the balance sheet, not everything I'll get into because I don't want to really confuse, specifically beginners, but I'm going to keep it such that you understand at least what you're looking at, how to go further, and how to just have an overall assessment of the company. Because the next thing I'm going to speak about is the ratios and how you can do analysis on the balance sheet. All right. So the company would have had an IPO where they issued shares. So that's why we're seeing share capital here as opposed to the year before. So in 2024, they had not issued any shares to the public. Now they have, so that makes up their share capital here. We have reserves. Reserves are pretty straightforward here. Treasury shares, I'll get into that another time, but that was one of the things that was noticeable when they did their IPO, in terms of they did what I don't think I'd seen that on a report for a while in terms of a treasury share. I don't think that it's worth going into for this video here, but they have it listed here. And then we have retained earnings. So as a company is profitable, each year the retained earnings increase, right? So when you have a financial year and you calculate the profit for that year, that profit doesn't roll over into the next year, right? So they would have accumulated in their retained earnings 1.2 billion in profits, right? So the higher the retained earnings, it means the more consistent and profitable the company has been, right? So 1.2 billion is pretty good in terms of retained earnings. It means that the company has had a stretch of profitable years. So that's a good sign here. If we see the retained earnings negative, it means that the company has probably been experiencing some losses, and so the retained earnings would be negative. So it's a good thing that this number is increasing. It means they have now capital for which they can, for example, pay a dividend from, right? Dividend is typically paid from retained earnings. So as a dividend investor, as an income investor, retained earnings is one of those things that you want to track. Then we have our liabilities. So this is split similar to the assets in terms of you have non-current and then you have current, right? So think of non-current liabilities as these liabilities that the company will owe past a year, and then think of the current liabilities as liabilities that the company is expected to honor within the next 12 months. All right. So let's start with the non-current here. We have lease liabilities. It just means that a lease, standard lease that you would expect. So some companies may, for example, lease the location that they're doing business from or their office spaces. And so that's kind of like done at sometimes in the form of a contract where it's X amount and they pay it over a period of time. So it's here at 129 million and it's down from 169. Then we have long-term liabilities. This is debt that the company has to repay. And we know that as a part of the IPO, they would have stated that they would have used a portion of the funds to pay down their debt. So they had 907 million and they've brought that down. They've cut it in half to 451 million. All right. So I hope you understand also that when I say they cut it in half, I know I hear somebody out there saying that's not exactly half. Sometimes I'll just generalize some of these things so you get a general feel for where the numbers are going, right? So you don't have to be a stickler to say, well, it's not exactly half, it's X number of percent. For a beginner, I would not be, I was going to use the word precise here. So it's not, I'm not telling you not to be precise, but again, in this case, when you're doing a quick analysis, you just want a feel for the numbers. All right. Either way, their non-current liabilities have decreased by almost 50%. Let me say it that way to be more, precise in my words here. So that's good to see that long-term debt is going down because, of course, debt will appear on the profit and loss, on the finance cost in terms of them having to repay that each year. So the lower that finance cost, the more profit the company is able to realize. All right. So in terms of current liabilities now, we have accounts payable. When a company does business and they have their suppliers or vendors, that's their accounts payable that they need to repay. So this is money that they owe to vendors and partners. All right. Lease liability. So you have the lease liability here that's long-term. And this lease liability here is probably what would have been due within the year or within the period. All right. So that's 40 million. And then you have current portion of long-term liabilities. So when you have the long-term liability, that maybe that 5-year loan or that 10-year loan or whatever amount it is, you'll have a current portion that is due within that period that the report is for. So 110 is the current portion of the 451 million. All right, hopefully that makes sense here. And then, of course, we have taxation payable, which is 5.4 million. Of course, the company is newly listed, which means their tax liabilities are going to reduce to 0 for the first 5 years. So this is probably just a remnant of what would have been previously owed. All right. So either way, now current liabilities come up to 299 million. We add that to the non-current liabilities, which is 580. Then we have 880 million. Then, of course, we need to add that to the equity, and that's how we get the 1.4 billion, right? And as you see, that balances with the total assets. So the balance sheet has balanced, right? So that's essentially how you'd look at it initially. So I'm going to pause there. I'm sure there are questions. I see some in the chat. I'm going to get to them now. But if you have any questions as it relates to the balance sheet, let me know. And then I'll talk about how to complete that analysis of the balance sheet. All right. So as Sitavar is saying, would be good if you use Woodcats, being that they're listed tomorrow. So I thought about that, but then at the same time, I wanted to just to do the 3 videos in the series for the same company so that, of course, somebody can watch all 3 and get a good feel for how they could analyze a company in terms of their financial statements. So I thought about switching to Woodcats, but then it may throw off some persons because there are some things that may go for Woodcats, even though they're kind of in the similar manufacturing sector. So I guess there's something to be said there for that. But yeah, I decided not to. Simone is asking if she has missed a lot. I don't think so. You joined 9:24. We started 9:15, so you missed maybe the first 9 minutes. All right. So impairment, Richard, let me look for the technical definition and not explain what I understand. So it says here an impairment is impairment accounting is a process of writing down the book value of an asset when its carrying amount exceeds its recoverable amount or fair value. All right, that's what it says here. I'm not sure if that's clear. Right. So it's when I mentioned impairment here is that, and I can't remember which company I saw it for recently. Oh my gosh. There's a company whose financials we looked at. Level 3, remind me, was it level 3 or level 2? We did one session and we were talking. Okay, so the next time I see it on a statement, I'll probably just do a video around it here. Let me see another definition here. Another definition says, let me share my screen here. Impairment is a permanent reduction in the value of a fixed asset or intangible asset when the market value drops below the recorded book value. Impairments are entered as a loss on the income statement. So it says, unlike depreciation or amortization, an impairment is unexpected. Depreciation and amortization are planned value reduction. Impairment happens when assets suddenly lose value due to market changes or obsolescence, I think. Yeah, okay. What's the purpose of an asset impairment? So I think I'd used it for when, for example, the company had accounts receivable. It's just something that I've seen. Let me see if they have it here for specifically that. And this is also why I didn't want to get into it, because I'm hoping that I'm not confusing anybody here. All right. So it's saying here where the impairment is recorded. Guys, bear with me. I'll probably just try and do this in a separate video because I really don't want to come to confuse anybody. This was meant for beginners. So Richard, I know you're in level 2. We'll probably do a session specifically for that for you. So because I want to give you the explanation, but I don't want to confuse anybody who may be brand new. All right. King Byfield is asking how to calculate ratios. Well, I'm going to go into one example to help you to understand, but then of course we're going to do a particular video on ratios to go in depth, but I'm going to show a simple ratio called the current ratio here. So I'm going to go to do that one first. Let me share my screen here. So the current ratio, as you can see here, let me click on it. Maybe I shouldn't have clicked on it. Let me click on it one more time. Yeah. So the current ratio is when you take the current assets and you divide it by the current liabilities, right? So remember, on the asset side, we saw their current assets. On the liabilities side, we saw their current liabilities. So you'd calculate the current ratio by taking that number, dividing it by the other, and what we're looking to see is, for example, how many times we can pay our current assets, we can pay our current liabilities from our current assets. Right. So let me do a calculation using them, and then we see what that looks like. Right. So the current assets here is 1.1 billion, and their current liabilities here is 299 million, right? So let me get the values here. Of course, I'm going to use any reason to open up Excel. Thank you for that question. Give me a chance to open Excel. So we have current ratio is equal to current assets over current liabilities. All right. So that's how it's calculated. So we're going to take the current assets which is 1.1 billion. So it's 1.11103,821. And then the current liabilities is 299,969. All right. And I'm just using the amount without the thousands so that it's easier. All right. Let me zoom in as well. All right. So we're pretty much dividing the assets by the liabilities here. So I'm going to do equal this number divided by this number. And we have here 3.67. All right. So typically, again, this would be 3.67 times. This is actually excellent current ratio. It means that they have enough in current assets to cover their current liabilities 3.67 times. All right. Hopefully that makes sense, King Byfield. It means that they don't have any concerns in the short term to be able to take care of their current liabilities, right? Whether it's to pay their vendors or pay bills or pay taxes or anything like that. They don't have that concern because they have enough in current assets. Now, sometimes it's good to look at the current assets, right? So for example, you have what's called like the asset test ratio, where you minus the inventory from the current assets. Because you notice if we take away the inventory here, which is 664 million, if we take this away, then the remaining value is about 438 million versus 299. So it's not the same amount of room that they would have, because of course their inventory is 664 million. So the ratios have to be taken within context, and you have to use the right ratio to get a proper understanding of the company. Because if you did the current ratio and got 3.67 times, you may say, yes, they're in a good state, but it would be better to do the asset test to see how, if they have enough liquidity to be able to take care of their short-term obligations, right? So you really use ratios to get just a high-level understanding of the balance sheet itself or any financial statement. You want to use ratios in the context of the industry. So for example, you would not compare the ratio of a company in manufacturing to a company in finance, or a company that's in like infrastructure business, or in the medical field, things like that. So you want to compare them in that way. So the ratio is to help you to analyze the company itself, comparing period over period, but also to compare the company to its industry. All right. King Byfield, let me know if that was helpful. Carrick is asking on Instagram, can a company's balance sheet be good but bad to invest in? That's an awesome question. Short answer is there a short answer here? I would say the caveat that I would say, I was going to say yes, but then I paused, because so here's what I would say to that. And it's an excellent question, by the way. So you want to look at the company as a whole, meaning you don't want to just look at the balance sheet. Now, there are statements that I would look at depending on the type of stock, meaning if I'm investing in a company for dividends, there are things that I would look for in each of the statement. If I'm investing in a company for growth, there are different things that I look for. And so you want to bear that in mind. Can the company have a good balance sheet but be bad to investing? Short answer is yes, right? Because there are kind of ways to, the balance sheet alone doesn't speak to the quality of the company. It's one of the pointers, but it's not the only pointer. All right, hopefully that makes sense. So you can have a company with a good balance sheet, and good being relative, of course, but maybe they're having, like, maybe the cash flow statement is pointing to some concerning things, so it wouldn't make a good investment. Or maybe they realize a lot of profits on paper, but it's not actual cash, right? Because maybe maybe their cash flow from operations are negative, so that they always need cash to be able to, take care of their obligations. So really, you don't want to take just one thing or one statement to determine whether or not something is good or bad to invest in. Absolutely great question, though, to ask. All right. Any other question before I move on? All right, I'm not seeing any questions. I'm going to take it for granted that you guys are just, getting it, and I was crystal clear, and, I did such a flawless job that you don't have any questions at all, or you could just, be processing and you need a few more minutes. I'm going to give you a couple more minutes to ask any questions that you may have. What I will mention again here is that usually what I do is I look at the statements in the following order. So I look at the profit and loss first, I look at the balance sheet second, and then I look at the cash flow third. That's the order in which I look at the statements. If I don't like what I see on the profit and loss statement, I'm not going any further, right? And this is just when I'm doing a quick analysis of the company, right? But I have a preference for the P&L first, because the very first checkbox for me is whether or not the company is profitable. If it's a dividend stock, I need to know the company is profitable. If it's a growth stock, I need to know the company is profitable. So, I mean, not that I wouldn't invest in a company that has negative earnings, because of course the context matters. It could be a one-off. It could be that they're having a bad period and they may recover. Like, different things can impact that. But I try not to invest in a company that is not profitable. And I'm pausing because I've done so many investments. I'm trying to remember if I've ever invested in a company that wasn't profitable. I think I've done that. And it didn't end well. It didn't end well, right? I have invested in a company that wasn't profitable. It did not end well. All right. Let me see another question here. I have another question outside of the balance sheet, so I'll wait. Ask it now, Kerry, because we're almost done here. All right. Next question is, what about the liquidity of the company? All right. So you have liquidity ratios that you can look at. So for example, so you have different types of ratios, right? So one of them that we looked at was the current ratio and the quick ratio, or the asset test ratio. So liquidity is measured by a few things, right? So you have, and I actually prefer to use CFI. So let me see if CFI or Investopedia is good too, right? But Corporate Finance Institute or Investopedia, two great sites to use for this. So it's showing the type of liquidity ratios here. So we did the current ratio already. You have quick ratio, you have cash ratio, and what it does, it shows you the ratio and how to calculate it. All right. So those are, I think this is just a great site to work with. It shows you examples, shows you the numbers, etc., etc. So I'll cover ratios in a separate video, but liquidity is going to be important to assess for the company for sure, right? And it says here, the importance of liquidity ratios to determine the ability to cover short-term obligations. We spoke about that before. To determine credit worthiness. So a bank, before they give a company a loan, they're going to look at their liquidity. And if you think about it, that's what banks do for us as well. They look at our personal liquidity to see whether or not we can cover our loans. To determine investment worthiness. So those are the three things it lists here as the importance of liquidity ratios. So it's very important. It's something that you do as a part of your analysis. So yes, great question. All right. Is Woodcats really starting to trade tomorrow? Yes, Camry. The listing ceremony is tomorrow. I believe Renee will be in the building, so she'll be at the Jamaica Stock Exchange to be a part of that ceremony. Maybe we can get a brief, clip or something of the team, depending on how it goes. But yes, they are listing tomorrow. I've confirmed multiple times. So yes, the wait is over. I see another question here. The question is, what are the anticipations for the upcoming Trans Jamaica board meeting? I will just have to wait and see a video after. I don't know. I don't know. I have my suspicions in terms of what to expect, but we will see. We'll see in a couple of days, right? That's all I can say for now. But dividend consideration notice was released last Friday, and so we will see what it looks like when the declaration or the confirmation of whether or not they'll be paying dividends is announced, and then we'll see from there. Okay, that's all I can say for now, Carrick. Yeah. I'm checking just our platforms for any other question in case I missed anything. I'm checking inside our community to see which stock would you consider doing a thesis on? I'm not sure how to answer that question. I do a thesis on all the stocks that are on my watch list, certainly every stock that's in my portfolio. So, I mean, that's that's too high level a question. Maybe you want to phrase it a different way, but I do a thesis for every company that I am considering to add on my watch list. Now, the thesis doesn't mean that I'm going into any long process or taking days. I could just go through the statements and create a thesis, in my head about whether or not I want to make an investment in this company or not. If I'm going to put a large amount of capital on it, then I will do deep analysis. I'll do deeper research. So for me, if I'm putting, let's say, more than $1 million in an investment, then I'm going to do a full thesis of the company. If I'm maybe taking a position maybe for a few $100,000, I may not do a full thesis. I may just see something that I think would lead to some growth and then do my investment based off that. But that's not the type of investor I am anymore. I used to kind of do things short-sighted, but not so much anymore. I'm going to do a proper analysis. So yeah. Hopefully that answers the question, but as I said, that's a very high level question. So Carrick says that laugh, say nothing more. No, I'm just, oh boy, there's so much, a lot has been happening in the market, guys. I hope you have all seen it. There are a lot of opportunities on the market. Some opportunities that I never saw at the start of the year are now. I mean, we're pretty much 3 months into the year already. It's been a good year to be an investor, and so I mean, a lot to laugh about. All right, so since there are no more balance sheet questions, I think I'm going to end this video here. I don't want to make it too long, but yes, just to confirm that Woodcats is opening tomorrow. And so for those of you who would have applied for the IPO, if you don't see your shares in your account tonight, then you may not be able to trade with it in the morning if you want to. But of course, I think tomorrow and the next few days will be a good lesson for those of you who are new to understand how a new listing can trade. And so I'm certainly going to be looking at that. I'll be in the queue tomorrow, seeing how the stock will will trade for sure. Let me see if it's, let me check something here before I close this stream off. I just want to see if the ticker is shown. They're junior markets. So I'm assuming it's Woodcats. I don't know. I don't see it yet. Did I apply for shares? I think I did. Hold on. I'm just making sure I'm not sharing my screen here. Okay, so the symbol is Woodcats. I do see shares in my account. So yeah, okay. All right. Okay. All right. So that should. Okay. Okay. Interesting. So the ticker is Woodcats, and yep. All right. Let me see if I'm missing any comment. Let me check Telegram as well. So for those of you who are here, who are brand new, if you want to join and take our level 1 investment course, the link is in the description of this video. Okay, I'm seeing some comments here. Saw the lab movie? No, I did not. Can you send it to me? Send it to me either on Instagram or on Telegram, please, or inside our Kajabi community. Is the platform you checked JTrader? Yes. Let me see if I can bring it up without revealing my account details. Hold on, let me go to, can I show a part of the screen? No, I can't show a part of the screen, so I can't share it, but yes, I'm seeing it on JTrader. The units are showing on NCB. Oh, yep. Not seeing them on Moneyline as yet. You probably see tomorrow. Hopefully, sometimes that happens. So there's a general rule that I have where persons would ask me why I have 8 brokerage accounts. It's because of things like this, right? So the lead broker will typically sort things out on their side first, right? So if NCB is a broker, if I'm applying for that IPO, I'm applying via NCB. If VM is the lead broker, I'm applying through VM. I find that it's just easier that way. I mean, it shouldn't be, but it just is, right? So NCB is the one that brought them to market, so I'm not surprised it's showing on NCB and not on Moneyline. It may take till the end of tomorrow, but theoretically, everybody should have it for trading day, but let's see. What I've heard sometimes that it doesn't show until the end of the first day, right? So let's see. No other questions. So, all right. Enjoy the rest of your day, guys. Look out for the 3rd video in the series where we'll go through the cash flow statement. And of course, I may do a video on Woodcat opening day, depending on how tomorrow goes in terms of schedule. Level 2, we're meeting this Saturday. So for those of you in level 2, this Saturday is our monthly call. And of course, for everyone else, you're free to sign up for and take our level 1 course to get started with investing. All right. So take care. You've always heard that you need to invest, but you don't know where to begin.
Don't worry, leave that to us. We've been teaching people how to invest for the last 8 years and have helped over 45,000 people get started with investing in a simple way. And now we've made the process even easier by creating a course that teaches you how to get started investing in 5 simple steps. And it's called our L.E.A.R.N method.
Before you invest, you need to 1, look at your financial position. 2, establish your personal goals. 3, assess your investment options. 4, research the best options for you. And 5, normalize investing regularly.
With these 5 easy steps, you can start your investment journey with confidence and clarity. But wait, there's more. We've created templates and resources to help you take action right away. After this course, you will know how much you have to invest, your investment targets and timelines, and how to invest to achieve your goals. Register now at learngrowinvestclub.com.